Morning, students. Welcome back. And we are discussing about accounting standards. So, in the last session, we started with accounting standard on employee benefits, which is about the liability-based accounting standards. So, today we plan to continue on this topic. Okay. So, before we move further on this topic, let's do a quick recap. Yeah. So let's do a quick recap in terms of some of the things that we covered in the previous session. So just give me a minute, I'll just share the presentation. Okay, so in the previous session, so we talked about employee benefits, wherein we discussed that what is going to be that employee benefit, which will fall within the purview of this accounting standard. Yeah. As regards the employee benefits, the most important aspect we understood was about the relationship between the employer and the employee. Okay, so only and only when you have that relationship between the employer and the employee, which would be in respect of permanent employees or maybe the casual labor, which could be a formal arrangement or informal arrangement. So different aspects could be attached to that. But therein we discussed that the service contract with a vendor should not be confused with the employer-employee relationship, and that is one sort of assessment one will have to do. Okay. Now, once you have this employee benefit, then we discuss that in respect of accounting requirements. All of these employee benefits are required to be segregated. Yeah. So they are required to be segregated. We can say there are 4 categories of employee benefits: short-term employee benefits, long-term employee benefits. Long-term is all about other than this post-employment and termination. Then we have this post-employment, we have termination employee benefits. Okay. Now, why is this categorization important? Because depending on the category, accounting will vary. Yeah. The first category, short-term employee benefits, we discussed. We discussed as to when would an employee benefit be considered as short-term employee. So quickly, can you help me understand what is a short-term employee benefit? Over to you now. So in the previous session, when we talked about short-term employee benefits, what is your understanding on this? Over to you quickly, everyone. Great. Rajveer says, wherein the employment is for 12 months. Ashda says, which are due for settlement, means those amounts which will become due for payment within next 12 months. Correct? I think same is the understanding from Rohan as well as Prem. Very good. Yeah. Okay. Now, as regards the employee benefits which are short term, we understand that they will be termed as short term if they are due for payment, if they are due for settlement within 12 months, within 12 months from the end of the reporting date, or you can say the balance sheet date. For example, 31st March 2025. If let's suppose that is the balance sheet date. So from that date, any benefit which is due for payment up to 31st March 26 will become short term. Correct? Now, as regards the short term employee benefits, we further discussed about the accumulating and non-accumulating. Okay. For the accumulating one, we discussed that if the benefit is accumulating in nature, okay, so there again you'll have to assess in terms of its liability as to how the liability should be provided, whether the liability should be provided or not. Correct? Now, in respect of non-accumulating employee benefits, non-accumulating are those which are not really carried forward. They will lapse within the same financial year. So that's why, do we need to do anything about non-accumulating employee benefits? Tell me, what do you think? Do we need to do anything about non-accumulating employee benefits? The answer is no. Don't do anything. Yeah. Yeah. Very good. So Ishan, Soumya, they're saying you don't do anything. And why don't you do anything? Because if they have lapsed, so that means the cost in respect of those employee benefits, whatever be that cost, that has already been captured. Okay, that has already been recognized. Okay. Now, if let's suppose that is not incurred, so the cost will not arise. Yeah, but that will not go beyond the reporting date. Why? Because if they are not going beyond the reporting date, so why would the cost go beyond? Okay, or why should the liability be kept outstanding for this company? Correct. All right. So this was about short-term employee benefits. Now what we will start with is post-employment employee benefits. Okay, so now we are going to pick up this second category. Okay, post-employment employee benefits. Now, let's try to understand as to what is a post-employment employee benefits. Okay, post-employment employee benefits, as you can just also understand from the terminology, are those. Okay, these are those benefits which will arise, which will be available after the employment. After the employment means post-employment, means after the employment. Okay, now some of the examples in respect of post-employment employee benefits could be gratuity. Okay, gratuity is a, you can say, a very common and mostly applied, you can say, employee benefit which falls within the purview of this. Why? Because it's something which is applicable to every entity. Okay, so every entity will have some gratuity amount in respect of its employees. Correct. Another example could be medical benefits. Okay, medical benefits which are provided to the employees post retirement. Now the important point here is to understand what is this retirement or post employment. Okay, yeah, because that's how you will be able to understand the segregation. See, if let's suppose an employee is required to work with the company, okay, and his or her retiring age, let's suppose, is 60 years. If the employee continues to work up to 60 years, so 60th year, or you can say after completing 60 years, employee will retire. Correct? So in such a case, any benefit which is provided to the employee after retirement, that is what you call as post-employment. There could be one more situation. Say an employee doesn't continue to, doesn't work with the organization. Okay, so he's not continuing with the employer. See, after a few years, he left the organization. Okay, means the employee has left the organization. His retirement is going to happen when he will be 60 years or completing the 60 years. But before 60 years, if let's suppose employee has left, Now, at that point of time, when the employee is leaving the organization, that is what is also called as post-retirement or post-employment, if at all any benefit is payable. Understood? Yeah, clear on this as to what is this post-employment? Yeah, so post-employment doesn't necessarily mean that the employee has to retire after completing the age of retirement. Okay, so that is not necessary. Clear? Now, as regards these post-retirement employee benefits, or you can say post-employment employee benefits, there could again be two categories. Yeah, so again you'll have this segregation of the employee benefits into two categories once again. Yeah. Now, what is that segregation? First is called as defined contribution plan, and the second one is called as defined benefit plan. Okay, so you have these two segregations, defined contribution and defined benefit plan. Now, once again, why is this segregation, this categorization important, or why is this required? Because again, depending on the categories that you have, accounting will vary. Okay, so it's the similar thought process, right? Yeah, so here again the accounting will vary depending on the segregation which is there. Okay, now what is this defined contribution plan? What is this defined benefit plan? Let's try to understand both of them with the help of examples. Okay, so now what I'll do is I'll just take you to a working file. Just give me a minute. I think Deepika has a query. I'll just come to your query, Deepika. Just give me a minute. Okay. Deepika is saying that government job employees retire after 60 years. They will be covered after post-employment. So once again, I think you need to understand it in a different manner. See, it's not about which type of employees will get covered. It's about which type of employee benefit will fall into this category. Okay, so let's, I think, understand this part first of all. So the term says post-employment. Okay, post-employment benefits. Right? Now, as I told you, it's not about which type of employee will get covered. It's about which type of benefit will get covered. So let's take two examples to understand this. Say an employee is working with a private company. Okay, Mr. A. Mr. A is working with a private company. And then you have Mr. B. Mr. B is also working with a private company. Now in this case, Mr. A must be getting salaries, bonuses, okay, various types of employee benefits while they are in an employment. Okay, so they have been working. So Mr. A has been working with the organization and getting the benefits. Okay. And let's suppose on a particular date, say 26th May 2035, Mr. A decides to leave the organization. Yeah. Let's suppose he has decided he'll leave. When is the retirement of Mr. A due? His retirement, let's suppose, will be due in say 2000. 50. Okay, so if Mr. A doesn't leave before 2050, okay, so then 2050 will be the year when the retirement age will be there, 58, 60, again depending on the policy of the company. So Mr. A has not continued till the retirement age. Before that, he has left. Now let's suppose the day when Mr. A has left, at the time of his retirement, this company pays him gratuity. Okay, while he was in employment during this period, gratuity was not paid to him. Gratuity was not paid to him. When was this gratuity paid? Post employment. Post employment means once his employment is over, whether he has left the organization, means whether he has quit or whether his retirement date has arrived, irrespective of that. So in such a case, what do you call this gratuity as? Tell me. This gratuity is an employee benefit. Yes or no? It's an employee benefit. So any benefit which is paid by the employer, what do you call it as? Employee benefit? Yeah. But will you be calling it as short term? No. Can you say that this has been provided to the employee because he has been terminated? No, he has not been terminated. He has left. So again, it's not a termination benefit. This will also not be called as long term. So long term is a category about which we'll speak later. So what do you call this benefit therefore as? Post employment. Okay, post employment means provided after the clear. Now let's talk about Mr. B. Mr. B has continued up to the date of retirement. Let's suppose he has been getting a lot of benefits, and the day when he retires, okay, over here, he will get gratuity. He'll get gratuity. So there again, what do you call this gratuity as? Post employment employee benefit. Yeah. So in our case, does it matter whether the employer is a private company or a government company or any type of organization? No. Do you think it will matter as far as post employment benefit is concerned? No. Yeah. Now clear on this? Now clear? Yeah. As to what is the understanding of a post employment benefit? Correct? Okay. Now moving further. Now we will discuss about defined contribution plan, defined benefit. Okay. Now, as we discussed, for the purposes of accounting, these post employment employee benefits again they have been segregated into two categories: defined contribution plan. Okay, so that's one, or defined benefit plan. Okay, so that's the second category. Okay, yeah. Now let's try to understand about both these plans and then we'll talk about their accounting requirement. So first of all, let's talk about defined contribution plan. So this is defined benefit plan. See, defined contribution plans are those plans in which case a contribution is made by the employer. Contribution, you can say a payment. So this payment could be made by an employer to a third party or to any fund or maybe to anybody. So why is that payment made? Payment is made in respect of providing some benefit to the employee. Okay. So payment is made to provide some benefit to the employee. So who will make the payment? Employer will make the payment. Okay. Now, in respect of this payment which is made by the employer, if let's suppose after making that contribution, any further liability in respect of such employee benefit will not fall on the employer in any scenario in future. Means there's no sort of risk which will be falling on the employer. Means employer is going to get risk free. Risk free means in terms of bearing that liability. Okay, for example, say if you talk about Mediclaim. Okay, I'm just trying to give you an understanding as to what is this contribution. Let's suppose Mediclaim everyone understands. Okay, so Mediclaim policies that we have, right? So in case of a Mediclaim policy, once you pay the premium, yes or no, what will happen? If let's suppose tomorrow any liability arises, why? Because let's suppose the employee falls ill, employee is not well. So who will bear that liability? Will that be the person who has made the contribution initially? Tell me. Who will bear the liability? The answer is no. The liability will not fall on the person who has made the contribution, because after making the contribution, let's suppose a person pays some premium. Say the premium amount is 25,000. Now, once this contribution is paid, any future liability that arises, let's suppose this person is Mr. A again. So will that liability fall on Mr. A? No. So who will bear that liability? Third party. Mediclaim. Yeah, it's a Mediclaim benefit. Okay. So the insurance company will bear. Correct. Similarly, if let's suppose we take one example of pension. Generally, when it comes to the pension, let's suppose employer is ABC Limited. Say the pension is payable at the time of retirement. Okay. So this is the time when the pension is payable. So this is the date of retirement. Okay. Now, in this case, for this period up to the date of retirement, what will happen? This employer, this company will keep paying an amount to the pension fund. Generally, it's paid to the government. Okay, let's suppose it's government recognized pension fund. It's a government recognized pension fund. Means that of the government. So it's a government pension fund. Okay, in this case, employer will keep making the payment. Correct? Say every year some amount is paid. Every year. Right? Now, as per the rules, what will happen when the employee will retire? So the amount of pension will have to be paid to the employee. Okay. And in respect of the contributions which are made, okay, there is some fixed return which the government notifies, which is also payable to the employee. Right? So in future, we understand some amount is payable. Some amount is payable as per the government norms. Of course, as per the policy, but the government norms will also have to be considered. Now, if let's suppose all of these contributions which have been made and the returns which have been generated on all of these contributions, okay, they fall short of amount which is payable to the employee. Yeah, so let's suppose there's a shortage. Shortage will arise only because of the return which is required to be paid on that. Okay, now the question arises that this amount payable, if let's suppose this has to be 100, but currently the amount which the fund is able to provide is only 90. So there is a shortage of 10. Yeah. So now the question arises that in future, will this liability fall on ABC Limited? So in this case, the answer is no. Why? Because it's the fund of the government. Okay. So therefore, any shortage in terms of this liability on the returns, for the same, employer will not be responsible. What is the responsibility of the employer? To make these contributions. Of course, these contributions are the responsibility of the employer. Once these are done, okay, these contributions are also defined. Once these are done, employer is completely risk-free. Risk-free in respect of what? This future liability. Okay. Yeah. So such type of contributions are called as defined contribution plans. In which case, future liability is not going to arise on the employer. Yeah. And in this case, accounting requirement is also very simple. Every year, the contribution which is made, okay, these contributions which are paid, employer will have to record them as expense. Simple. So every year, what is the accounting entry employer will pass? Expense debit to bank, expense debit to bank, expense debit to bank. And which type of expense is that? Employee benefit. Again, under the respective category, you will put it into the financial statements. Okay, so you do not have any complex accounting requirement. It's a very simple accounting requirement in respect of defined contribution plans. Okay, everyone clear? Any questions? If you have on this, please let me know. Any questions? Over to you. Richa is asking, sir, defined contribution plans or the PF, these are two different? No. This particular PF example which I have given, you can say it's an example of defined contribution plan. To make you understand what is a defined contribution plan, this is an example. Okay. Two different things are what? Two different things are two different categories. I think somewhere you are confused. Yeah, for the post-employment benefit plans, sorry, post-employment benefits, there are two categories that we need to look into. Defined contribution plan, defined benefit plan. Okay, so we are just trying to understand what is a defined contribution plan. How is this required to be recorded? Clear? Richa, now Deepika is asking, but in some cases, PF are 50-50 contribution of employer and employee. So it's not in some cases, it's in all cases. The important part is that 50% portion which the employer has deducted from the employee, 50% portion which employer has contributed on his own. This entire 100 amount, once this is paid by the employer to the government, liability of employer is over. Okay, that's what we are calling as a defined contribution. So it's not that it is coming from employee or employer is making on its own. That's not the point. Clear? Rohan is asking, sir, under whom liability will fall in case of pension? See, that will be falling on this pension fund. Okay, so therefore, government will have to pay this. This pension fund will have to pay this. Okay, and in this case, this pension fund is not that of the employer. Yeah, so whoever will have this pension fund, they will have to pay this. That's the responsibility of this fund, pension fund. Okay, clear? So for example, I think as around pension, okay, so this understanding that you have, let me just clarify this. Okay, let's suppose every year, let me just put the amounts. Yeah, let's suppose every year 50 is the contribution of employee, 50 is the contribution of employee. Both of them are contributing 50 each year. Next year again it's 50. See, the contribution of employee is also required to be deposited by employer. Yes or no? Yeah. So this is how it will go on. This is how. Yeah. So when it comes to the pension, every year when you are making this contribution of 100 to a fund, so the fund is also required to pay some return on this. If let's suppose you put some money in a bank, do you get some return on that or not? Tell me. When you put some money in a bank, maybe in the savings account, in the fixed deposit account, do you get some return on that? Yes or no? Yes or no? Do you get some return on that? Yeah, you call it as interest or whatever you want to call it as. You get some return. Now same is the case over here. These amounts, when these are paid to the fund, so the fund is also supposed to provide some return on this. Okay, let's suppose in this year it was 7%. Let's suppose in this year it was 7.1%. Let's suppose it's 8%. Let's suppose it's 7.5%. Okay, so that's the responsibility of the fund. What is a fund? You can say it's a fund house. Yeah, so they manage this fund. It's their responsibility to provide this return. If let's suppose fund is not able to generate this much return, every fund will have a corpus. Yeah, so the fund should be able to generate this much return, only then the fund will be able to provide this. Now the question arises, where are these returns getting from? So the government notifies this. Government specifies that this is the percentage return which will have to be provided on pension, or the amount of pension. Okay. Now let's suppose in these years fund has generated 6%. Yeah, so the corpus will fall short by the amount of this return which the fund has to provide to the employee. Yes or no? So who will bear this liability? Will it fall on A Limited? Answer is no. This will fall on pension fund. Yeah. Now clear on this? Now clear? Charandeep is asking why the employers do not have their own pension fund. See, it's not that the employers do not have their own pension fund. It's all about management. Huh? So some of the employers do have their own pension funds as well. We are talking about a situation when the pension fund is not that of the employer. Why? Because the moment you say it's the fund of the employer, then it will not become a defined contribution plan. Yes or no? Yes or no? Right? Then it will not become a defined contribution plan. It's a defined contribution plan. Why? Because it's not the fund of the employer. But there are some employers who maintain their own funds. Yeah. So a lot of companies have this provision. They keep their own fund. Yeah. Clear? Clear on this now? Okay, great. Chandeep is clear. Any more questions on this? On this defined contribution plan? Yeah. Okay, great. Frame is clear. Yeah. All right. So now, so this was about defined contribution plan. And for this defined contribution plan, we have also discussed the accounting. For an employer, this contribution which is made each year, that's an expense. So ABC Limited will record this amount as an expense each year. Correct? Yeah. So this amount will be recorded as an expense each year. Okay. Now, moving on to the second category. Okay, so we have the second category as defined benefit plan. Defined benefit plans. Now, what is defined benefit plan? Now, unlike defined contribution plan, if there is a plan in respect of which any future liability will fall on the employer. Okay, any future liability will fall on the employer. then what do you call it as? Defined benefit plan. Now in this case, let me just pick up the same example that we were discussing, okay, so that you can get this clarity. So in our example, there was an employer, okay, who was making the pension payments each year, okay, and this is the date when the pension will be payable to the employee, correct? Now each year, if let's suppose employer is paying 50 plus share of employee, okay, so let's suppose this is what the employer has been doing the way we discussed. Yeah, so the way we discussed, this is what the employer is doing. And now the employer is different, it's PQ limited. So we have a different employer, PQ limited. Okay. And we also understand that on all of these amounts, there are some returns which are required to be provided. Now, employer is not keeping all of these funds with himself. Employer is making this contribution to a pension fund, and the name of the pension fund is PQ pension fund. Yeah. So this fund is owned by PQ Limited. This is owned, managed by PQ Limited. Now, in this case, the question arises that in future, if let's suppose amount payable comes out to be 100, okay, or let's suppose 1000, but the fund has been able to generate, okay, so the fund will generate through two sources. So if you look at the fund, so where do they get the money from? Two sources. One is of course from these contributions, and second is from these returns. Yes or no? Yeah. Now let's suppose employer has estimated that the money payable to the employee will be 1000, but the fund has been able to generate, let's suppose, only 950. Now there is a shortage, correct? So there is a shortage, we can see clearly. So in this case, who do you think will bear this liability of 50? Who do you think will bear this liability? Charandeep says employer. Rohan, Ishan, I think they have the same response. Deepika has the same answer. So now, in this case, despite the contributions being made every year, any future liability which arises, is the employer relieved from that future liability? Does that risk of future liability not fall on the employer? Can we say that? The answer is no. Why? Because this fund is that of the employer only. So any shortage in the fund will have to be borne by the employer only. Yes or no? So in this case, even though the arrangement is exactly similar to the arrangement that we discussed in the previous example, okay, so there is no difference in the arrangement. That entire arrangement is exactly same. Yes or no? This entire arrangement is exactly same. No difference in that. Correct? Despite that, despite that, now this plan will become what? Defined benefit plan. Now you will not be calling it as defined contribution plan. Now it will become defined benefit plan. Why? Because the future liability, the risk for this future liability continues to remain with the employer, or you can say that falls on the employer. Yeah. The moment you say employer is free from that risk, where do you go? Defined contribution plan. And the moment you say the future risk will be there with the employer, so what do you call it as? Defined benefit plan. But please remember that all of these plans we are discussing in relation to what? In relation to post employment employee benefit. Okay, so we are not talking about salary payable on a monthly basis here. We are not talking about bonus which is payable after 1 year. No, we are talking about those employee benefits which are payable after retirement, which are payable post employment. Clear? Everyone clear? I can see some questions coming up. Okay, great. Ishan is asking, but sir, if in the defined contribution plan, if the fund is of the employer, then also the liability will fall on the employer. I think, Ishan, you have not understood this completely. See, in the previous example, if you go back to this example, okay, so this fund is not of the defined contribution plan. Yeah? So defined contribution plan is not the owner of this fund. Okay, or nowhere it is written that this is a defined contribution plan. Depending on the type of arrangement it is, you will have to say whether it's defined contribution plan or anything else. So don't get confused with that. So this example, considering the entire arrangement, what did we say? What did we conclude? It's an example of defined contribution plan. Okay. Now, the moment we see a different scenario, we evaluate that, and what do we find? That it's not a defined contribution plan. It's a defined benefit plan. Clear? Okay. So to say that in a defined contribution plan, you will have this arrangement, that's not true. Yeah? Clear? Chirandeep is asking, sir, here employer has to look into the returns also. Yes, because please understand, why will the liability fall short when the contribution is made each year? Only because of the returns. So it's the returns which will create the problem. Okay. Deepika is asking, sir, difference between defined contribution plan and defined benefit plan. In both the cases, contributions are same. You tell me the difference. What's the difference? So can anybody answer this question of Deepika? So she is asking, sir, in both the examples, contributions were exactly same. Employer was making the contribution. So what is the difference? I think that is what we have discussed so far. So can somebody answer this? Over to you quickly. Over to you quickly. Yes. Very good. Devu says liability to employer. which falls in the future. Risk on the risk as around the payment of the liability that falls on the employer in case of defined benefit plan. Okay, Ishan is saying if it's a defined contribution plan, future risk is not with the employer. It's a defined benefit plan, future risk will be on the employer. Then I think the name is missing. She's saying who will bear the liability if the difference is there, whether employer or third party. Correct. That's how you'll have assess this. Yeah. So I'm saying future liability in defined contribution plan will not fall on the employer. Whereas in case of employer, it will fall on the employer. Clear, Deepika? Yeah. So please understand that whether it's a defined contribution plan or a defined benefit plan, in both the cases, contribution will be made. Payments. So what is a contribution? Contribution is nothing but a payment. So don't just go by the term. Okay, contribution means every year payment will have to be made. But what is going to be the point of differentiation? So how do you segregate them? Okay, so now let me just write this for you. So just give me a minute. So in case future risk, okay. So future risk will not fall on the employer. Here, future risk remains with the employer. Okay, so that's how you'll have to segregate. Yeah, clear? Okay, Sunil is saying, I think Sunil was also answering that. Very good. Ron is asking, sir, where both employer and employee are contributing, whether the benefit will return, whether the benefit will be return on employer contribution only or on return on both. See, once again, you are just trying to create a unnecessary confusion for you. For us, for this segregation into defined contribution plan and defined benefit plan, we do not need to get into that split. Okay, whether the return should be there on employer's contribution or employee's contribution. Why do you want to get into that? That will be dependent on the type of employee benefit. That will be dependent on the scheme. That will be dependent on the policy. Okay, so if you ask me in this particular question, entire contribution which will go should generate some return. Okay, but that's not how you should be doing this segregation. Clear one? Yeah. Otherwise, you will not be clear on the concept. Okay. So every time a policy, a benefit scheme could be different. Yeah. Prem is asking, sir, in case employee leaves the employer before retirement and the pension is on defined benefit plan basis, then if the employee go to other employer, then how will this pension work? I think now what you are trying to do is now you're just trying to get into the matter of HR. Please understand we are discussing about accounting. It's a class on accounting. Yes or no? So how will a policy work? How should a policy be framed? What type of employee benefit should be provided? What type of employee benefit should not be provided? What should be there in a particular scheme? All of these matters are required to be taken care of by whom? HR, okay, human resource department in an organization. You are not a part of HR department, you are a part of accounting department. For you, what should matter is that whatever is the scheme, whatever is the type of employee benefit, you assess that, okay, on the basis of fact pattern which is available, and you do the accounting for the same. Okay, so that's how you should be going about it. Now, as regards uh, the point that you want to understand, as to how it should work, how it should not work, please remember that all of these things may vary from company to company. Okay, so there is no defined answer to this. If let's suppose an employee will leave, will go somewhere else, maybe somewhere else this pension scheme is not available. Maybe the new employer doesn't provide any pension, okay, or maybe the previous employer doesn't provide pension, new employer may provide pension. Okay, so all of these things may vary from employer to employer. So there's no standard answer to this. Clear? Yeah, it will be all dependent on the policy of the employer. So that's how it works. So whatever is the policy, that will have to be looked into. Clear? Yeah, Prem, Rohan, I'm just hoping you are clear on this. Great. All right. So now, as around defined benefit plan, any more questions if you have, any more doubts? Quickly. Any questions, any doubts? No? All right. So now what we will do is, we'll look into some terms. See, I would say in this particular standard, the most important part has to be defined benefit. So that's how you should be considering this. Most important part, right? And in fact, something which you'll call as complex, if at all you find that will be only this time, nothing beyond that. And if you have understood this defined benefit plan, that means you have understood the most important part of this accounting standard. Okay. Yeah. Now, moving on to the accounting requirement. But before we get on to the accounting requirement, let's understand two terms. Now, in this case, when the employer is making these contributions each year, okay, I'm talking about this 100, which will go to the fund each year. So that will be an investment by the employer. That will be an investment by PQ Limited. Yes or no? Yes or no? Tell me. When these contributions are paid to a third party, pension fund is a third party. Whether it's owned by PQ Limited or not, it's a third party. Yes or no? So these will be called as investments by PQ Limited. And in the books of PQ Limited, these will be appearing as assets. Yes or no? Kind of, right? So now, at one place, if you look at the books of PQ Limited, here, if let's suppose, if you look at the books of PQ Limited, PQ Limited will have a liability to pay 100. Correct? Now you may be thinking, but sir, why there is a liability? This is already paid. I'm just coming on to that one. See, in future, PQ Limited has to pay this rupees 100 to the employee. Forget about the return for the time being, right? And corresponding to this liability, what PQ Limited has done is PQ Limited has invested this money somewhere so that in future, when this liability arises for this liability becomes due for payment, PQ Limited can make this payment from this asset or from this investment. Yes or no? Yeah. Is that the correct understanding? Yes or no? Tell me quickly. Yeah. Clear on this part? For PQ, there will be a liability and there will be one asset. Now, as regards this liability, there is a nomenclature for this. This will be called as defined benefit obligation. So what do you call this liability as? It's an obligation, but the technical name of this liability is defined benefit obligation. Okay, and this asset or this investment is called as plan asset. Okay, once again, this is the technical term that you use. So one is defined benefit obligation, second is plan asset, or you can say corresponding to every liability there is an asset. Yeah, generally every employer will be making this investment. Yeah, so therefore in the books of the employer you will have two things. One is a liability and second is the asset. Correct? Correct. Now let's go back to this example. Okay. And please also help me understand. Are you aware of the concept of present value? Present value, do you understand what is the meaning of present value, future value? Have you covered that? Yeah. So can you help me understand the meaning of present value, meaning of future value quickly? Everyone. I want this response from everyone. Meaning of present value and meaning of future value. Over to you quickly. This is very, very important. Why? Because this will help you in the accounting of defined benefit plan. Over to you quickly. What is your understanding of present value? What is your understanding of future value? Quickly. Great. Tanisha has explained. Tanisha says present value means market value of the current asset. Okay. Okay. Then I think she's saying present value means today's value of future cash inflows or outflows, and future value is tomorrow's value of today's money. I think I have received similar responses from Rohan and Prem. Charandeep has given an example. He is saying investment of 100 may become 300. May become 300 after 20 years. And in such a case, 100 is what? Present value. 300 is what? Future value. Great. So I think on the similar lines, Rajveer, Tanmukh, they are also answering this. Very good. Now let me also give you an example, maybe for the benefits of those students who are not aware of this. Say you have rupees 100 today. Okay. Let's suppose today you have 100. You go to a bank, you deposit this money with the bank for 1 year. Okay, so you have told the bank that please keep this money with you for 1 year. Bank is saying okay, fine. Okay, but you are asking the bank that in return for keeping my money, what will you pay me in return? So bank is saying okay, no problem. Okay, I'll pay you 10% interest on this. Okay, so the bank will pay interest on this at the rate 10%. So after 1 year, what will it become? After 1 year, this amount of 100 will turn to 110. Right? So now in this case, after 1 year means we are looking at future. After 1 year, value of today's 100 becomes 110. So this 100 is called as present value. This 110 is called as value of future or future value. Okay. Present value will always be lower than the future value. Why? Because of interest. Or you can say if one has to compute the present value of 110, which is after 1 year. So what will you need to do? You will have to remove the portion of interest from this. If you take out interest from 110, what will you get? Present value. Yes or no? Yeah. So now tell me one thing. Now a question for everyone. Huh? Tell me one thing. Let's suppose today is 26th May. Okay. So we are taking that example. So it's 26th May 2025. If let's suppose this person has to do this accounting. Okay. For this person, 100 will be an asset. 100 will be an asset or not? Right? And for the bank, this 100 will be a liability. For the bank, this 100 will be a liability. Yeah. Now, in this case, if the bank and these persons or this particular person have to do the accounting, at what amount they will record this? Can they do the accounting at future value? Tell me. If the accounting is required to be done today, can you record this asset at future value? Answer is no. How can you record something at future value? You will have to record that at present value. Yes or no? So any accounting needs to be done at what? Present value only. Yes or no? Yeah. And in our example, present value and future value are different. Correct? Okay. All right. So now, this was about the understanding of what is present value, what is future value, what is interest. Interest is also called as a time value of money. Okay, so interest is nothing but time value of money. Right? So we have discussed that whenever you have to convert future value into present value, what do you need to do? Remove the interest portion from that future value. Yeah. The only problem is that you'll need one interest rate. for doing this exercise. If the interest rate is available to you, you can do that easily. Yeah. So if the interest rate will be available to you, you can do that easily. Charandeep is saying, yes, sir, we can do the discounting. That's correct. Yeah. In fact, that's the concept of financial management, or maybe, whatever you call it as. Yeah. So now the question arises that why did we get into this concept of financial management? How is this relevant at all? What is the use of this? Because we are accountants. You may be thinking that's just a while back we discussed that we are accountants. So why do we need to get into all of these concepts? So for our accounting purposes only, we need to get into this. So let's understand as to where is this really relevant. So we were discussing about defined benefit plan, correct? Now, in case of defined benefit plan, today, today, contribution of 100 will be paid. Yes or no? Yes or no? And today, PQ Limited needs to ascertain that in respect of services which are rendered by the employee, what will be the amount of pension fund which will be payable to the employee, let's suppose say after 20 years. Yes or no? Yes or no? That is what the employer would need to know. Why is that relevant? Because employer will have to record this liability, because every year employee is rendering services, and in return for the services employee is getting lot of benefits, and one of the benefit includes pension fund, which is not payable today. See, the only point is amount of pension is not payable today, that is payable after 20 years. But is that not accrued today? Of course, that is accrued. Why? Because every year employee will render services and the accrual will happen. So every year some accrual has to happen. Correct? Every year some accrual has to happen. Right? So therefore, for ascertainment of this liability at the end of 20th year, standard says a valuation should be performed for the same. Okay. And for doing this valuation of this future liability, because this liability has to be ascertained for the future. Correct? This liability has to be ascertained for the future. So that's why entity should involve one expert who can compute this liability, who can do this valuation for you, and that expert is called as actuary. Okay, actuary you can say is a valuation expert. What value is that? Actuarial valuation. Yeah. So defined benefit plans are required to be recorded using one methodology which is called as projected unit credit method. Okay, so that's the method that you call it as, and for which entity will engage an expert. What do you call that expert as? Actuary. Who will do this valuation for you? Okay, now let's suppose today you go to an actuary, and actuary says after 20 years 1000 will be payable, right? So what is he ascertaining? After 20 years 1000 will be payable. Now tell me one thing, that knowingly that in respect of the services rendered so far. So I'm just talking about the past period. So you may be thinking, but sir, future period do we consider? No, ignore the future period. Let's suppose in respect of the period which has been covered by the employee so far. Okay, all of these past years, the services which the employee has rendered. You go to an actuary, you ask him, tell me what is the amount of liability which will fall on me. Okay. So actuary says after 20 years you'll have to pay 1,000. So should we record this 1,000 or not? So do we need to accrue this liability? Answer is yes. We will have to accrue this. Why? Because employee has already rendered the services. But can you record this amount today in your books at rupees 1,000? Tell me, can you record this amount in your books? Can PQ Limited record this amount in its books at 1,000? Answer is no. Why no? Tanu, Rohan, Somya, they are saying no. Why no? Chandeep is saying because sir, it's the future value. It's the future value. Okay. So that's why if anything has to be recorded, so at what amount you will record this? At the present value. So therefore its present value should be worked out. Yes or no? So what do you need to do? You need to compute its present value. Now the question arises, but sir, who will compute the present value? So that present value will again be computed by the actuary only. Yeah. So that value will again be computed by the actuary only. You are the accountant. You don't need to do that. Let's suppose actuary has computed and its present value comes out to 800. Now this 800 you will record. Correct? This 800 you will record in your books of accounts. Correct? So at what amount do you record this in your books? At present value. Clear? Everyone clear so far? Any questions, any doubts so far? Over to you quickly. Any questions? Soumya is clear. Very good. So then I think we can take a break. Yeah. So I think we can see we are not yet done. Okay. So on this defined benefit plan, we are going to continue. Ron is asking, sir, once again, say the name of the method. Projected unit credit method. I'll write down. Don't worry. Yeah? Ron. Okay. So we have just started this. So this method will take a lot of examples. Okay. But it's like we are not yet done. Idea was to just make you understand what is this present value, future value, and how is this relevant. So you would have understood that how is this relevant, where is that applied. Okay, now after the break what we will do is we'll just continue on this method in terms of a lot of items which will generate because of this, and then we'll pick up examples. Okay, clear? So let's take a break and let's meet after the break. Manish, we'll take a break. All right. So now moving further. Okay. So the next point is in terms of the liability. If let's suppose you have any liability, okay, like in the previous example, for 1000, let's suppose this present value comes out to 400. Now, if you record a liability of 400 today, so year on year, interest should also be recognized on this liability. Yes or no? Yeah, correct. Tell me quickly. Yeah. Okay. Now there are a couple of things which are important to be understood in this case. Okay, and that's how the accounting will have to be looked at. Let's suppose today, okay, this is today's date. You are recording a liability of 400. Why did you record this liability of 400? Because in the past years, employee has rendered a service. Okay. You are not required to pay this amount today. Of course, this payment will have to be made in future. You understand this will be payable in future. Yeah. But you can't record the future values. That's why we have recorded the present value. But what is this liability for? This liability is in respect of the services which are rendered by the employee up to this date. Correct? Now, every year, if let's suppose we say that if let's suppose employee stops rendering services, so what is the amount you will pay to the employee? Tell me, what is the amount you will pay to the employee? Quickly. If let's suppose employee stops rendering services today, what is the amount you will pay to the employee? 400. Okay. So that means 400 will be payable to the employee today. But let's suppose employee has left, 400 is payable, but the entity doesn't make the payment. Okay. Let's suppose 1 year is gone. So on this 400, will there be a liability of interest or not? This 400 was payable to somebody. If you don't pay him on time, so will there be an interest liability in addition to 400? Yes or no? Yes or no? Yeah. Deepika is saying we should also add penalty. No, penalty please ignore. Okay. So therefore, till the time this liability is not paid, every year what will happen? Interest will be added. Yeah. Similarly, if let's suppose employee has not left, he is continuing with the organization, and because the amount is payable to him but is not getting paid. Why? Because this will be paid to him at the time of retirement. Therefore, on this liability or on the liability of each year, interest needs to be recognized. Right? Only then this 400 will prove up to 1000 in the future. Correct? Now, further, one more thing is going to happen. Every year, employee will keep rendering services. Correct? Yes or no? So for the period of services which are rendered till date, let's suppose this is 26th of May. Let me just call it as year end. That will be better. Let's suppose this is 31st March 2025. For the services rendered till 2025, sorry, 31st March 2025, expense amount and the corresponding liability amount on a cumulative basis was 400. But if the employee continues to remain with the organization every year, in addition to 400, some additional expense and the corresponding liability will arise or not? Yes or no? Every year for the services which the employee will render, some additional amount will become payable to him over and above interest or not? Tell me, some additional amount will be payable to him or not? Yeah. What do you call that amount as? That is called as current service cost. Okay. So every year, this current service cost will keep getting added. Yes or no? Yeah. So therefore, in the books of the employer, every year there will be two types of costs. One that will be current service cost, and second will be the interest cost. Okay. Corresponding to all of these costs on a cumulative basis and all of these interest costs on a cumulative basis, there will be a liability which is called as a defined benefit obligation. This will have to be netted off. This will have to be netted off. Netted off why? Because the plan asset which the entity will have, okay, will have to be reduced from this liability. And then you present this liability. So in the P&L, there will be two costs. And in the balance sheet, there will be this liability. Correct? Yeah. So this part is understood. Any questions so far? Is this part understood? Easy? Quickly? So far, is this part understood? Easy to understand? Quickly? Please confirm. Okay, now let's try to understand one more part which is attached to this. Prem is asking, sir, is this liability under which head you'll so under this employee payable? Okay, so that is where it will go. Then I think she's asking, sir, current service cost and the interest cost are the same, right? No, they are not same. Then that's what we discussed. They are different. Current service cost is for the services rendered. Interest cost is the interest that you will accrue on the outstanding liability. Okay. Rohan is saying I couldn't get it. So Rohan, it's very simple. In this case, there are two components, Rohan. Did you understand these two components? Tell me quickly. So there were two components over here that we discussed. Are you not clear on these two components? We talked about these two. Quickly, please confirm. Yes. Yeah. So interest is the interest that you will book on this liability of 400. Do you understand this 400 is a liability on which interest will have to be accrued? Tell me quickly. Yes. So what do you call it as interest? Clear on the interest portion, Ron? On the interest portion, you are clear? Very good. Now, this 400 liability was in respect of what period? Tell me. This 400 liability was in respect of what period? Up to what period you have this liability of 400? Quickly, fast, huh? Up to what period you have recorded this liability of 400? Waiting for a response. Frame says up to 31st March 25. Okay, now tell me one thing, that after 31st March 25, will the employee not render services? The answer is yes. Employee will render services. So in respect of the services which are rendered, will you not pay him something? Of course, yes. So the amount that you pay him for every year's working, every year that he work, and the amount that you will have to pay him, what do you call it as? Current service cost. Rohan, clear on this now? Yeah. So for every year, the amount that you will have to pay him, that is current service cost. So where do you take this? Because these are expenses. So expenses under which uh, under which component you will take it? Will they go to balance sheet? Where do they go? Tell me, Rohan, quickly. P&L. Clear? And in respect of this liability of 400, where will you take it? Balance sheet. If you have this liability of 400, where do you take it? Balance sheet. And what do you call this liability as? Defined benefit obligation. Okay. The only point is that any liability that you'll have, okay, this DBO, this is also called as DBO. This is always shown as net. Now, what is the meaning of net? Means from this defined benefit obligation, any asset which the entity will have, that will have to be deducted, and the net amount will be shown here. Okay, that's why it's called as net. Okay, that's why it's called as net. Clear? Ron, clear on this? Ron is asking, sir, this current service cost will be exclusive of interest. Yes, of course. And that's why we are saying there are two costs. Isn't it? Yeah. Now let me just go back. Huh? Okay. Now let me just go back. Now tell me one thing. I have a question for you. Yeah, again, very, very important. See, today, when you are on 31st March 2025, so what did you do? You went to an actuary and you asked the actuary that after 20 years, what is going to be the liability? Okay, so let's suppose this entity was PQ Limited. So PQ Limited went to the actuary and asked the actuary that after 20 years, what is the amount that I'll have to pay? So actuary estimated 1000. Yes or no? That's what actuary did. Yes. This is what the actuary did. Correct. Tell me quickly, this is what the actuary did. Yes or no? So actuary computed this amount of 1000. Now there's a long period which has to come in future. Can the actuary be 100% sure that this amount will be 1000? Tell me, is it practically possible? No. That's why what the actuary is doing is actuary is estimating this. Actuary is estimating this amount. So this amount is what? It's an estimate. With 100% accuracy, you cannot compute an amount for future. Why? Because future is uncertain. There are a lot of assumptions which the actuary will have to use. For example, PQ Limited may have 100 employees to begin with. Maybe out of these 100 which were rendering services, 90 remain on 31st March. Okay, and for these 90 employees, actuary has estimated that suppose 20 more will leave the organization. So at the end of 20 years, actuary has estimated 70 employees will be there to whom this 1000 will have to be payable. Okay, some of the employees will leave, some of the employees may die. Okay, and of course, on this amount which is payable, increments will also have to be considered. Yeah, so there are a lot of factors which the actuary considers. There are a lot of assumptions which the actuary considers. Plus, there is also a discount rate. Discount rate, you can say, is the interest rate. If this present value is computed, so can you compute the present value without the interest rate? Tell me, can you compute the present value without the interest rate? Not possible. Not possible. So all of these factors, all of these assumptions which the actuary considers is required to be done each year. Okay, so every year this valuation will have to be computed, or you can say this will have to be updated. Yeah, which means that maybe at the end of 31st March 2026, this estimate of 1000 may become 1100 or may become 1075. Yes or no? Yeah. So one factor for increasing this amount will always be the current service cost. So every year you will keep adding current service cost. But if you keep aside this current service cost, the existing cost which you have estimated may also change. Why? Because over the period of time, a lot of assumptions may change. Estimates are required to be reassessed. Yes or no? Yes or no? That will have to be done. Right? Right? That will have to be done. Yeah. Because of which this future liability may change. Correct? Yeah. Do you get this? Yeah. That over the period of time, a lot of assumptions which the actuary would have considered may change, which may result in changes in the liability. Yes or no? Yes or no? Yeah. So therefore, every year, when this liability will change, so this will be because of three factors. What is the first factor? Can you tell me what is the first factor? Interest. Okay, so the first factor will be interest. What is the second factor? Current service cost. And what is going to be the third factor? All those assumptions of the actuary. All those assumptions of the actuary. Clear on this? Everyone clear? So every year this liability will change because of three factors. Yeah, everyone clear on this? Any questions, any doubts so far? Please let me know. Yeah, everyone clear? So now, what I'll do is, in this P&L portion, I'll now add one more portion. Okay, I'll add one more portion. And what is that? Actuarial assumptions. Okay, so that's why what I'm doing is I am updating this table. So in the P&L, every year liability will get updated because of three things. First, current service cost. Second factor is interest. Third factor is assumptions of actuary, which is also, you can say, called as actuarial gain or loss. So because of these assumptions, liability may increase or decrease. Yeah, liability may increase or decrease. Yeah, so that's why you will have these three factors resulting in the change in liability, which will go to P&L each year. So one, current service cost. Second, interest. Third, actuarial gain or loss. So may I think then, sir, future value of 1000 might change due to the side factors? Yes, that's what we are discussing here. Yeah, clear on this? Everyone, please confirm if you are clear on this, then we'll pick up examples. Okay, I would say this is the most important part of this accounting standard. If you have any questions, any doubts, please ask me. But I'm sure once we go through the questions, you should get some more clarity. Okay. All right. So now let's move on to the questions. Jayendra is asking, Jayendra has a point. Sir, what's the difference between current service cost and salary? See, when you get compensation from the employer, yeah. So the compensation from the employer has got various components. I'm not sure whether you are aware of this or not. When you, let's suppose when the employer makes the payment to the employee, so one component is basic pay, okay, some part is allowance, some part is gratuity, okay, some part is say reimbursement. Okay, you get to see all of these components in the compensation or not, which is also called as CTC. Yes or no? Which is very commonly called as salary, but salary has got various components. Correct? Jend, are you aware of this? Yeah. So salary is what you can say a broad term, or you can say a term which is used in the context of CTC, cost to company. Okay. Now within this CTC, there are various components. One is basic, or you can say a lot of components which are paid on a monthly basis. And one portion is towards the pension, which is incurred but not paid on a monthly basis, which is paid at the time of retirement. So this current service cost pertains to that pension for our example, or depending on the type of benefit any organization will have. So the current service cost pertains to that benefit which is in the nature of post employment benefit and which will be payable in future but accrued today, and salary is about all other benefits. Clear? Jendra, clear on this? Very good. All right. So now let's look at this example. Omega Limited belongs to the engineering industry. Company received an actuarial valuation for the first time for its pension scheme, which revealed a surplus of 6 lakhs. It wants to spread the same over 2 years by reducing the annual contribution to 2 lakhs instead of 5 lakhs. Average remaining life of the employees is estimated to be 6 years. You are required to advise the company on the following items from the point of view of finalization of accounts, taking a note of mandatory accounting standards. So the standard says actuarial gain or loss should be recognized in the P&L. Therefore, a surplus of 6 lakhs. What do you mean by surplus? Last year liability was 10 lakhs. Now actuary has recomputed this. After 1 year, it comes out to 4 lakhs. So we are keeping aside current service cost. We are keeping aside interest. So we discussed that why would a liability change? For 3 reasons: current service cost, interest. So we are setting aside current service cost. We don't know about interest. Okay, so the third component has contributed to this. What is that? Actuarial gain or loss. So this 6 lakhs rupees is the actuarial gain during the year. So where do you record it? It will go to P&L, but because it's a gain, so it will be recorded as income. Clear? Simple, easy to understand. Yeah, everyone quickly clear on this? Clear on this? Okay, great. So now let's look at next example. Okay, now we will get into some calculations also, and I'll suggest that without looking at the solution, you try to attempt this on your own. But please remember now, without looking at the solution, because if you look at the solution, you will not be able to understand the concept. Fine. On 1st April X1, fair value of plan assets was 1 lakh in respect of a pension plan of Zealous Limited. So you understand what is a plan asset? So on 1st April, its value is given to you. After 6 months, on 30th September X1, plan paid out benefits of 19,000 and received inward contributions of 49,000. Okay, so there was a plan in which 49,000 was received, and the plan also made some payments of 19,000. On 31st March, means after another 6 months, fair value of plan asset was 1,50,000. And the present value of defined benefit obligation was 1,47,920. Okay. During this year X1, X2, actuarial losses were there, 600. Okay. On 1st April X1, company made following estimates based on its market studies. Okay, so company did this estimate that the interest and dividend income after the tax payable should be 9%. So it's the return which the fund should generate. Realized and unrealized gain on the plan asset should be 2%. Then the fund will have a cost 1%. So net the fund or the plan asset should be able to generate 10.25%. Okay, so that's what the company has estimated. You are required to find expected return on plan assets and actual return on plan assets. Okay, yeah. So let's try to solve this. Okay, so what I'll do is I'll just get into one working file and we'll try to solve this. All right. So now, if we look at the plan, value of plan asset was what? 1 lakh. Correct? That's the value of plan asset. Right? Now, if you look at the requirement of the question, it says management has estimated return should be 10.25%. So return on plan asset. Okay, over next 12 months should be what? 1 lakh into 10.25%. Yes or no? Yes or no? Yeah, so that's what the management will estimate. Correct? Yeah. Okay, now if you look at the plan asset, now let's try to understand its movement. Okay, on 1st April, X1, what was the value of plan asset? 1 lakh. Correct? On this 1 lakh, up to 31st March, X2, if this 1 lakh continues to remain as it is, what will happen? Return will be generated. Yes or no? So on this 1 lakh, return will be generated at the rate 10.25%. Now during the 6 months period, okay, sometime over here, that means 30th September 2000 X1, it says new contributions are received. So 49,000 is the inflow. These are the additions. These are the additions. Means this fund receives some more money. And there were some payments out of these funds. What was that? 19,000. So on a net basis, 30,000 is the amount one can say. So on a net basis, we can say 30,000 is the amount. Yes or no? Yeah. On a net basis, we can say 30,000 is the net addition to this fund on this date. Yes or no? Tell me quickly. So on a net basis, 30,000 is the addition to this fund. On this addition, should there be some return or not? So on this 1 lakh, For example, when you are estimating 10.25% should be generated. So similarly, on this 30,000 for the next 6 months, same way, you will expect some return to be generated. Yes or no? Yeah. So therefore, what should you do? So return on plan asset over next months, we can say on the opening balance of rupees 1 lakh. Yeah. So what is that? That is what we just computed. Similarly, return on the plan assets over net inflows over next 6 months. So what will that be? That will be 30,000 into 10.25%. Yes or no? Right? Divided by 2. Divided by 2. Correct? Yeah. So therefore, at the end of the year, what should be the total expected return? 11,788. Yeah, I think in the study they have considered this rate at round off. Okay, instead of just doing half of 10.25, they have picked up 5%. Okay, so let me just also take it at 5%. So this is the expected return. Correct? This is the expected return on the plan assets. Correct? Everyone clear so far? Everyone clear so far? Simple, easy to compute. Yeah? Everyone clear? Quickly. Now, what is the next requirement of the question? Compute the actual return on plan assets. This was the expected return. This was the expected return. Now we will compute the actual return. Actual return on plan asset. Fair value of plan asset. Or you can say closing balance of plan asset. In fact, what I'll do is I'll just follow a different approach. Okay. So we are given opening balance of plan asset. Right? What is the opening balance of plan asset? Quickly, please confirm. What is the opening balance of plan asset? Quickly, 1 lakh. Right? Additions during the year. What are the additions during the year? What are the additions to the plan asset during the year? 49,000. Tell me the gross amount. Huh? Right? So you will add that less deletions during the year. What are the deletions to the plan asset? 19,000. Now, from the opening balance, if you add the additions, delete the deletions, what should you get? Closing balance. You should get closing balance. Yes or no? Yeah, you should get the closing balance. So your closing balance should be what? 1,30,000. Yeah, your closing balance should be. I'm saying your should be closing balance should be what? 1,30,000. But the question has already given you a closing balance. Question has already given you a closing balance, right? So what is that? 1,50,000. So which means the balance is due to some return on plan assets. Okay, this is what? This is your balancing figure. Okay, that has to be what? 20,000. Yeah. So if you add all of these, what do you get? If you add all of these, now you are getting 1,50,000. Got it? Yeah. So this is what you have derived. Okay, this is your balancing figure. Clear? Because only when you add this much return, you will reach the closing balance of 1,50,000. Simple, easy to understand. Any questions, any doubts if you have so far, please let me know. Was this simple? Any questions? Any doubts if you have? Tell me quickly. Everyone clear? Yeah, everyone clear? Okay, Charandeep is asking, sir, plan assets means investments that the company makes. Yes, that's correct. Rohan is asking expected return. Expected return is when you have an opening balance or you have some additions, or let's suppose if you have some asset. So you are expecting that at a particular rate, what should be my return? So that is your expectation. Okay. Jayendra is saying actuarial loss treatment. See, actuarial loss treatment will not arise because we didn't discuss anything about liability. It's only about assets. Yes, only one part we have looked at in the question. Yeah. Sabha is saying, sir, expected return. Expected return means, see, if you have invested somewhere, Sabha, let's suppose you have rupees 1 lakh today and you plan to invest it. Okay. And you are thinking that in the market you will be able to make 10.25% return. So what is going to be your expected return? Tell me. Sabha, what is going to be your expected return in such a case? Over to you quickly. What is going to be your expected return in such a case? Sabha, are you with me? So in that case, what is going to be your expected return? Over to you quickly. Are you with me? Sabha, you're there or not? Seems she's not there. Okay, anyone else? Any more questions? Okay, then I can see one more query. She's asking, sir, plan assets is equal to defined benefit obligation? Not always. So plan asset will be there corresponding to defined benefit obligation. May or may not match. It may happen that against a liability of 100, employer is only investing 90, only investing 80. Employer may not be investing at all. So it's not necessary that plan asset will be there. But if you have a plan asset, that will always be corresponding to a defined benefit obligation. Clear? Yeah. In my example, or you can say that was an example wherein we considered the amount to be equal. Okay. When you present it in the balance sheet, you will present it net. Okay. Harshda is asking, sir, do we need to write about losses or just to ignore? In exam, will it ask about losses See this question that you just looked at. Okay. So this question asked you only about plan assets. So what is there about the losses? I am assuming that when you are talking about losses, you are talking about actuarial gain or loss. Yeah. So actuarial gain or loss is a concept which is associated with a defined benefit obligation that has got nothing to do with the asset. Yes or no? So when you are not looking at anything around the liability, why are you thinking about it? Then you should also say, sir, do we need to compute the liability? Okay. So for example, if you are solving a question on AS15, will you think that, sir, should we also be looking at AS10? Should we also be looking at AS12? It's like that only. Yeah? So anything which the question is asking you, you will answer that. Remaining part, the question is not asking you, will not answer that. So that's how you'll have to go about it. Okay. You need to be very, very specific to the requirements of the question. Fine. Ron is asking, can you move the screen up? See, it's picked up from the study material only. Yeah. So you'll have this. I'm sure you're referring to the study material also alongside. Yeah. So you can just look at the solution over there. You need not write it down. Yeah. Anyways, it's there. Yeah. Same way. Okay, Ron. Clear on this? Then I think on query she's asking, sir, present value of actuarial valuation is defined obligation. See, present value will be for both the things, for defined benefit obligation as well as plan assets. Let's try to understand this. Okay, what is the present value? First of all, you need to be clear about the present value. So I'll pick up the same example. So 1000 is the liability which actuary has estimated for the services rendered by various employees up to 2025. Okay, but can you record this future value in respect of the work completed up to 31st March 25? No. Why? Because this 1000 is the future value. So that's why you request the actuary that please compute its present value. So actuary computed the present value for you. It came out to 400. So that is what you recorded. Correct? Yeah. So this 400 is what? Present value of defined benefit obligation. What is a defined benefit obligation? It's the nomenclature which is used for liability of post retirement, post employment benefits. Okay. Now, if let's suppose corresponding to this liability, employer has invested say rupees 300 somewhere. Let's suppose the valuation of the plan asset is rupees 300. Now this rupees 300 is the value as of today. This is the value as of today, right? So for today's value, if you compute the present value, what will it come out to be? If you have to compute the present value of 300 today, can you tell me what will be the present value of 300? Same 300, right? But if for some reason, okay, so let me just call it as a DBO. Okay, so this was a DBO, defined benefit obligation. But let's suppose for some reason, if the question says plan asset value is say 900. Okay, so future value, let's suppose, is given for the plan asset. Then if you have to record it today, can you record it at 900? Tell me, can you record it at 900? So what will you do? You will have to find out its present value. Let's suppose its present value is 300. So there again, what will happen? You have a present value of plan asset. So present value could be for anything. Important point is that anything has to be the future value. Okay. In the question, please understand all of these present values, future values will be given to you. I don't think you will be required to complete that. Number one. Number two, as around the P&L portion, as around the balance sheet portion, you should have a clarity. Okay. What is this DBO? DBO is nothing but the name of liability. Plan asset is nothing but the name of asset. That's it. Okay. So in the balance sheet, what will you record? In the balance sheet, you will record DBO on 31st March. You will call it as net. And can you tell me the amount at which the DBO will appear in the balance sheet? Over to you. On 31st March, can you tell me the amount at which you will record this DBO? 100. Yeah. Why 100? Because you will show it net. Clear? Yeah. So this is what you will do on 31st March. So this is what goes to the balance sheet. Now clear? Now clear on this? Yeah. Okay, great. Everyone clear? Any questions, any doubts so far? I think we'll not be able to pick up the next question now. Okay, so any questions, any doubts that still remain? I think we can discuss that and then we can just close our discussion for today. Huh? But in the meantime, maybe you can just note down next two questions. Huh? Illustration 8 and 9. Okay, so that's very much on the same lines, to a certain extent linked to the principle that we have discussed. Yeah, so it will be great if you can just attempt that on your own, try to solve that on your own. Okay, so that's a homework for you. If you do it, great. If you don't do, then anyways we'll pick it up in the next session. All right. Okay, so any questions, any doubts that you may have, let's discuss that. Over to you. So please remember that this part that we are covering of the AS15, this happens to be the most important part. I can see some queries coming around the attempt. Gaurav has this query. Gaurav, I am hoping you are clear on this now. Yeah? Gaurav, you are clear on this? Gaurav is saying, please repeat the question. I'm just hoping you're clear. So in this question, we discussed about the plan asset only. Okay, Prem is saying, can you please explain para 2 and 3 of page 6.4? Let me just go to page 6.4. And what do you mean by para 2 and 3? Okay, so let me just pick up this query from Prem. So I'm assuming that you are talking about, okay, so it appears it's related to illustration 2. Okay, so it says careful judgment should be applied in assessing whether an obligation has arisen, particularly instances where an entity's practice is to provide improvements only during collective bargaining process and not during any informal process. If the employer has not set a pattern, so if you remember when we talked about the obligation on the part of the employer, okay, that was the short-term one, wherein we discussed, let's suppose formally it's not there in the appointment letter, but every Diwali employer gives the bonus, so that's what you accrue. Okay, So it says, however, if the practice established by the employer was that of consistent benefit granted, either as a part of union negotiation or otherwise, yeah, it could be concluded obligation exists. So they are just saying that formal arrangement is not required always. Maybe informally, employer has a practice, okay, and this practice has become an obligation on his part. So that obligation you will provide, but that is in respect of short term only, huh? Which is discussed over here. Clear? Prem, clear on this? Just not clear about Gaurav. Gaurav, I'm just hoping you are also clear. Okay, so everyone clear? All right, so then I would say we can just close our session over here. Okay, but please remember in the next session, we are going to continue on this post-employment benefit. It's a very important part, and it's very, very important that you revise whatever we have discussed today. Only then you will be able to pick up the next questions. And it will be great if you can just also complete the homework. Fine. All right. So thanks everyone for your time and for this wonderful participation. Thanks so much. Yes.